What if I told you that some Australians are building multi-million-dollar property portfolios inside super, legally and tax effectively, and often without fully understanding how powerful the structure actually is? Today, we are talking about one of the fastest growing trends in the SMSF space, using SMSF to invest in property. But we are also going to talk about the mistakes people make. Because while property inside super can create incredible long-term wealth, I also see people getting it completely wrong every single week. And the problem is, most people only hear the exciting part on social media. They don't hear about compliance risk or borrowing mistakes or trust deed issues or double stamp duty traps, related party problems or liquidity disasters, or what auditors and the ATO are actually looking at. So today, I want to break this down properly. Welcome back to the podcast. I'm Natalia Clark, award-winning SMSF specialist, auditor, and founder of Easy Super. For more than 20 years, I've worked almost exclusively in SMSFs, helping Australians take control of their super properly with the right structure, compliance, and education behind it. Australians love property, and we understand it. We feel more in control of it when shares or managed funds. And many people are frustrated watching their super sit in a retail fund they barely understand. So naturally, people start asking, can I buy property inside super instead? And the answer is yes. And that's where SMSFs come in. An SMSF allows you to control how your retirement savings are invested, including residential property and commercial property. And for many Australians, property becomes the centerpiece of their retirement strategy. Why people are using SMSFs for property? First is tax advantages, and this is one of the biggest reasons. Because inside super, rental income is taxed at 15% only, and capital gains are discounted after 12 months, and in pension days, tax potentially be reduced to 0%. That is dramatically different to holding property personally on high marginal tax rates and paying 47% tax. Over decades, that tax difference can become enormous. The second reason why people invest in property using super is that SMSFs can borrow to purchase property using what's called a limited recourse borrowing arrangement. This allows trustees to combine their super balances, to combine contributions, rental income, and borrowing capacity to acquire assets that may otherwise be out of their reach. Over 15-20 years, the compounding effect can be very powerful. The reason number 3, business owners buying their premises. This is one of the smartest strategies when structured correctly. I see many business owners purchase their commercial premises through their SMSF. Then the business pays rent to the SMSF. This builds retirement wealth in a tax-effective structure. But again, it has to be set up properly. What about mistakes people make? Now, this is the important part. Because social media makes property in SMSF sound easy. But it is not. It is one of the most compliance-heavy areas of superannuation. And mistakes can become very expensive. Let's talk about mistakes. Mistakes number 1, setting up in the wrong way. I still see people setting up individual trustees instead of the corporate trustee, or making mistakes because they are trying to do it yourself cheaply online, and they set up their trust with cheap providers who don't even check the documents and advise on the process. Then years later, they discover that they have to pay a double stamp duty. The borrowing structure is wrong, or refinancing becomes difficult. Fixing mistakes later usually costs far more than doing it properly upfront. Sometimes trustees need to unwind the whole structure. Mistake number 2, not understanding related party rules. This is a huge one. Your SMSF cannot buy residential property from yourself. You cannot live in SMSF property. You cannot rent it to family or use it personally. The rules are strict. And I regularly see trustees accidentally breach them because someone online told them everyone does it. The ATO is looking at this area closely. Mistake number 3, liquidity problems. People become obsessed with buying the property but forget the fund still needs cash. An SMSF still has the expenses to pay: accounting fees, audit fees, tax obligations, loan repayments, insurance, property expenses, pension obligations later in life, and even the bank fees. If the entire fund is tied up in one illiquid asset, that creates a risk. Mistake number 4, borrowing without understanding the risks. Property is a long-term game. Things can change. Interest rates change, vacancies happen, markets move, legislation changes. And unlike personal ownership, SMSFs have strict contribution caps limiting how quickly money could be injected into the fund. That means cash flow planning becomes critical. Mistake number 5, thinking SMSF property is passive. This is probably the biggest misconception. Running an SMSF properly is not passive. Trustees have responsibilities. There are compliance obligations, investment strategy requirements, annual audits, valuation requirements, and strict CIS Act rules. An SMSF is not just an investment account. It is a regulated superannuation trust. This area is receiving more scrutiny from the ATO every year, especially related party transactions, market valuations, borrowing arrangements, contributions used incorrectly, and poor documentation. As an SMSF auditor, I can tell you, the biggest issues are often not intentional misconduct. Usually, it is trustees simply not understanding the rules, which is why education matters so much. Let's talk about who property in SMSFs may suit. In my experience, property inside super might suit established professionals, business owners, higher income earners, people with long investment horizons, and trustees who genuinely want involvement and control. But it is not for everyone. Sometimes staying in the industry fund is completely appropriate. And sometimes property inside super creates more complexity than benefit. Before you make a decision, you need to understand how SMSF works. You need to understand the compliance, the costs, the risks, and the long-term strategy. Australians are quietly building significant wealth inside super using property. But the people who do it successfully are usually not the ones chasing hype. They are the ones who are planning properly, understanding the rules, structuring correctly from day one, and thinking long-term. Because SMSFs can be increasingly powerful, but only when they are run correctly. If you are considering setting up an SMSF for property, make sure you understand how the structure works, what compliance obligations are, what borrowing actually involves, and whether it genuinely suits your situation. At Easy Super, we focus heavily on education, compliance, and helping trustees understand how SMSFs actually work in the real world. If you enjoyed this episode, subscribe to the podcast, share it with someone considering an SMSF, and follow us for more practical SMSF education.